whenever we are making the transactions, we will make there will be some instances where we will pay in the form of shares rather than in the form of cash. Especially when you pay in the form of shares, we are paying to the form of shares to the employees. Is that when we are fixing the compensation for the employees, what will happen nowadays? This is what happening nowadays everywhere in most of the multinational companies. Here I have written somewhere in the beginning, okay, I don't want to write it again. When you are making the compensation, what will happen? They'll fix the salary, they will fix the salary, and they will also give some shares with some terms and conditions that you can hold. You cannot sell the shares for the first 2 years, 3 years, or 4 years. Then afterwards you can sell the shares. The reason behind this is the concept of financial management is you have a agency cost. There will be because managers are the agents of the shareholders. When managers are the agent of the shareholder, there will be difference in opinion. What is happening is, if you involve management and we can assign them as a part of the responsibility, owner's responsibility, definitely what will happen? This gap will be reduced. Is that between the shareholders and the management, and the management will work in the interest of the entity as such. At every stage, depending on the designation, depending on the position, they will allocate the shares. Okay, here also it happens. If you take that once upon a time, I don't know right now, but once upon a time Navras was there, where then Navras used to give shares to his employees at different levels. Okay, some way back, if you take around 10 to 12 years back. Okay, this is what we are talking about. The most important thing what we have, see, they are giving you a equity settled share based payments and cash settled shares. Cash settled share based payment is not that much focused, as simple as that. Is it? Now when you are talking about when you are talking about the equity based payments, they say that how it has to be identified. Okay, when we are talking about it, is either it will be an expense or it will be an asset. Okay, either it will be an expense or it will be an asset, and automatically what will happen? The equity component, definitely to that extent it will remain, and once the expiration period is over, then the value of equity will increase. How it has to be measured? Very clearly stated, it has to be measured on the fair value, because share prices will always fluctuate. Definitely, if their share values are fluctuating, it has to be taken on a fair value basis. If you are providing it to the employees, if it is yes, you have to, when you are granting it at that date, today you are granting, today's share price you have to assign it. That's all. If in future it will increase, in the future it will decrease, that is not the responsibility of the entity. If it is with respect to goods and services, they will use it at the date they were received. Okay, when you are receiving the goods, is that it is more advantageous. See the thing, the simple concept is, you are making a transaction today. Is it that you are making a transaction on 23rd of September? But what will happen? You are receiving the goods on 25th of September. Okay. During meantime, there is a possibility. There is no guarantee that the value of the share will increase or decrease. If the value of the share is increasing, definitely what you will give, you will get the advantage. Is it that you will get the advantage? Whatever the price is there, you will pay less number of shares. If the value of the share is decreasing, then you have to pay more number of shares. Okay, that is the reason in both the situations the entity will be in the advantageous stage. Fine, that is what we are talking about. That there are two things. One is your grant date, when you are granting the conditions, and one is vesting, when you are transferring. Is that when you are vesting means when the ownership will be transferred to the counterparty. Is that when the ownership will be transferred to the counterparty. Fine. This is a small understanding. As I have posted the video also, that just go through the video, you will have some more clarity as such. Is that now what
Sure.
is it okay? Any doubts is there, you ask me. Okay. Now I will if even during these examples I will focus wherever it is required little bit more. What they are saying, they are talking about the first rule is what they are asking: calculate the impact of above share-based scheme on the Blueberry financial statements in each reporting period. Is that reporting period? This is the reporting period on 31st December, reporting period 2004, 2005 and 2006. Employees leave. See what happened? The employees will leave. Those employees will not be entitled to have these. They will say on the completion of 5 years, on the completion of 2 years. If the employees are leaving before that, definitely they will not get the full potential or full conditions of the rights which have been granted on the grant date, in the initial date as such. Is that they are asking you the thing. In the meantime, what they say, reporting the employees leaving 8, 6 and 2. For the leavers, expected period. What it says, if you are talking about the thing, the first year, second year, third year. Is it during the before last vesting date? Vesting date we have to take actuals. Is that vesting date we have to take the actual. Before vesting dates, any of the years, what you have to take? We have to take the estimates. Is that we have further levers expected during the vesting date, annual increase in sales volume, annual sales volume increase. That means they are talking something based on the sales performance. Is that what share-based payments is? Based on the sales performance, they are going to compensate the employees with respect to share-based payments. This is what we got and a little bit more understanding. Now what they say, on 1st January an entity, Blueberry, granted share options to each of the 200 employees. 1st January to, subject to what they say, 3-year vesting period. Is that till 3 years? Provided what is the condition? That the sales increases by 5% per annum. Okay, throughout the vesting period, every year the sales has to increase by 5%. A maximum of 300 share options per employee. They're saying that 300 maximum, dependent upon the increase in the volume of sales throughout each year. If the volume of sales increases by average between 5, this is the condition they have said, 5 to 10%, how much they are eligible? They are eligible to receive 100 shares. If it is between 10 to 15%, they will get 200 shares. If it is over 15%, they will get 300 shares options. Okay, they have got the 300. Now, see the things. What is they said the 5 to 10, 10 to 15 and over 15%. Is that what is they have given annual increase? 14%, 18% and 16%. Is that expected sales value increase over the remaining vesting period? 14% and 16%. What is the average annual increase? They gave the average annual increase with respect to the shares. Okay. What they are asking us? They are asking at the grant date, Blueberry estimated that the fair value, how much at the grant date? 10. And the increase in the share value, increase in the volume of the sales each year would be between 10 to 50. It is also estimated that 22% of the employees will leave period to the, because 22% will leave before the period. At each of the reporting date within the vesting period, the situation was as follows. Are you clear about this? What they are saying? See the things. Now, very simple. Read the first word in the question. That's very, very important. Here they are asking us to calculate. Is that they are just mentioning you to calculate. Then you have to calculate only. If they say advise and calculate, discuss, then things will be different. Is that things will be different. Now, what is the, how much they are saying? What is the formula I have written in the previous case? I have written one formula. What is that formula? In the first, is that what is the formula I have written? Somewhere I have written the formula. Here it has given number of employees to be on payroll. Is it the number of employees to be on the payroll into times options times fair value times duration. Is it right? Number of options, number of employees to be on the payroll. Is it right? This is what we have to take. More or less, we are not going to change anything. Okay? We have done some table here. 1 minute. We have done some table here. No, we have not done table. Okay? Fine. No problem. Is it right? No. Is it? First, what we have to do, make it a column. See that. See, once it is done, send me the screenshot how you have written. Very important. Screenshot individually on my WhatsApp number. Okay, I want to check how you are doing and how you are writing. Okay, what is the we have what they are asking, how it is going to be accounted. Fine. Vesting option, minimum 5%, maximum of 300 options. Okay, maximum of 300 options. If the volume of sales, fine, 100, 200 and 300 options. Is it right? In the first case, how many options will be there? In the first case, how much is the increase here? 14%. If there is a 14%, how many options will be there, share options? 10 to 15%. 10 to 15%. How many options? 200 options. Okay? Are you okay? Is it clear to you?
Doctor, can you repeat this part only?
Pardon?
Can you repeat this part only?
Yes. See the thing. What they said that if the volume of sales increase by average 5 to 10%, what is how many options they will get? They will get 100 options. Is it right? If they say that if it is increased between 10 to 15%, how many options they will get? They will get 200 options. Is it right? 200 shares. Now what is there? See the thing. The rule says that it is a test you are understanding for. Is that rule says that number of employees, is that number of employees to be on payroll, to be on payroll. This is not given somewhere. I'm just writing based on the into share options, times fair value times duration. Is it right? Times duration. Fine. Is it okay? Is it okay?
Yeah.
Fine. Now, at third, is it right? Is it fine? Now, how many? See, now they are see the thing. What is the turnover? 14%. It is there. How much is the turnover? In the first year, it is how much? 14%. Fine. In the second year, how much is the turnover? Average turnover. Average annual increase in turnover. They have mentioned that also. Is it right? If the volume of sales increases by average, is that they mention very clearly. If it is increased by average, if it is increased by average, we have to take which column? We have to take the average annual increase in sales. Okay? We have to take why we have to take? Because it is mentioned that by an average, okay? We have to take average increase, okay? Average increase. Now, if it is 14%, how much is the share options they will have? 10 to 15%. 10 to 15%. How many share options?
200.
200. 50 over 15%. How many share options?
300.
3. Over 16%. How many share options? 300.
300.
Okay. How many share options? 300. Now, fine. Now, how many estimated employees living in the year? How many employees will live in the year? How many employees will, total how many employees are there? Total how many employees are there here? 8 plus 6, 14 plus 2, how much?
16.
60. Okay. Now, is it? Now, what they say, employees living in the year, how much? 8. Employees leavers expected prior to the vesting date, how much? 18. Okay. Means how many total employees are expecting to leave? Employees will leave in the year 8 plus employees going to be leave within the vesting period is going to be how much? 18. Means how many employees will leave during estimated employees? How many estimated employees will leave during the year? The estimated employees will leave during the year is 18 plus 8. It comes to how much? 26. Is it? See, employees living in the year is 8. Further employees will leave prior to the vesting period is how much? 26 to 18. Okay. Means total employees will be on the payroll will be how much? Total, how many employees are there? 200 employees are there. 200 minus 26. Next, second year, how much is there? You have 8 employees will leave in the first year, 6 employees will leave in the second year. Okay, 6 employees will be leave in the first. 8 plus 6 plus 4, how much will get? It will become 18. Is that how much employees will leave? Estimated. This is an estimated. This is not actual. Last year, is that last year we have to take actuals. Okay, we have to take actuals. How much is there? It is 16. Is that? It has been given. Where it has been given, Svetlana, where we have done that? Tell me the page number immediately. Okay, where it has been mentioned, it has been mentioned somewhere. Where it has been mentioned on page number? Somewhere it has been mentioned. I will ask these things repeatedly. Okay. In the first case, we have to, in the first year, second year, we have to take the estimates. Okay. In the accounting treatment, where, please tell me fast. Okay. Where it is there. We have done this. We are the reporting based on, see here it has been given. The expense recognized at each reporting date should be based on the best estimate. Is that? Based on the best estimate of the number of equity instruments expected to vest. On the vesting date, the entity shall revise the estimate to equal number of equity instrument that will ultimately vest. Is that? They have to revise the estimate. What ultimately means? What is the actual amount? Ultimately, this what is the final actuals. Okay, this is what we are talking in terms of share based payment. Again, somewhere it has been given, okay? Again, it has been given, somewhere it has been mentioned that it has to be taken on a estimates, and we have to do on the C. It is on which page number? It is on page number 214, okay? It is on page number 214. Test your understanding for reference. Is that test your understanding for reference? Fine. Now this is what it says. Is it for what we have to do? First year we have to take estimates. Second year we have to take estimates, and last year we have to take actuals. Now when we take the estimates, number of employees, okay? First you will write reporting date. Is that first you have to type 1 minute. First I will put the columns. Reporting date. Is it right? Calculation of equity. Is it right? Calculation of equity. How much is the value of equity? Is it right? How much value of equity? Is it right? How much is the expenses? We are going to work it out. Okay. How much is the expenses? Is that we have to take net expenses. Is that we have to take net expenses. See the thing. Report. First you understand, then you follow it. Okay. 31/12/2004. Is it right? Follow the formula. I am putting it very clearly. Is it right? I will change the colors. Okay. I will change the colors for everything. How many are there? 200 minus. How many people are leaving? How many people are leaving? 26 people are leaving. Okay, 26. From where we calculate 26? We have calculated 26 from here. Is that 26 people are leaving? Fine. How much is the share option they will get? They will get a share option of how much? They will get a share option of 200. Is that what is the fair value? Fair value is going to be how much? 10. Is it? Fair value is going to be 10. What is the duration? 1 year is over. Okay, one year is over. 1/3. Is it? 1 year is over. 1/3. Are you clear about this? Number of employees to be on payroll. Estimate. Is that first year we will do the estimate. Estimate is what? I am putting very clearly here. Estimate of employees. Is that estimate of employees? How much you will get? Tell me. How much you will get?
$116,000.
116. Okay, we are taking 116 in thousands. Okay, these are in thousands. Now see, this is the expense for the first year. Is it right? It is the expense for the first year. Equity is 116. Expense is going to be 116. Second year, second reporting date, same one. Okay, 2001. How much is there? 200. How many employees, estimated employees are leaving by the second year? Second year estimated are 18. Okay, so estimated are 18. The estimated has decreased. Okay, now what is the percentage? They have reached 16%. Over and above 16%, how many share options they will get? They will get 300 share options. Okay, they will get 300 share options. What is the fair value? Fair value is 10. How many years has been over? 2 divided by 3. Is it 2 divided by 3? Now, how much is the equity they will get? How much equity they will get?
364.
364. 364. Already 116 is over. Okay, already 116 is over. During the current year, how much will be the expense? 364 minus 116. Is that expenses how much? The one side the equity will increase. Another side we will take the net expense. is that we'll take the net expense. 364 minus 116. How much is it comes? It comes to 248. This is the expense during the year. Fine. Are you clear about this? 31/12/2006. How many employees are there? We have to take actuals. Okay. The last year we have to take actual employees. Actual employees leavers. Okay. We have to take the actual. Here also what we'll take? We will take the estimate. Is it 200 minus how many people total is there? 16 times how many options are there? 300. Fair value is how much? 10. Now it is 3 by 3. Even it is we have to mention 3 by 3. How much you will get here? 184 times 300 times 10. How much you will get? 552. Check. Is that 552? Is that 552 minus 364? How much is there? 552 thousands. Okay, minus 364. What is the net expenses during the year? Net expenses during the year is 188. Is it clear to you? Yes, Johanna.
Doctor, why here 1 divided by 3 because of 3 years, right?
Yeah, because of 3 years. If it is 4 years,
Okay.
1 by 4, 2 by 4, 3 by 4 and 4 by 4.
Okay.
Okay, here I have mentioned here now, it is not there in the book, but I have mentioned this for our convenience. Is it? Number of employees to be on the payroll, share options, fair value and duration. Is it okay?
Yeah.
Now, see, now they have mentioned, they are only told about the calculations. Okay, calculate the impact of the above. Okay, calculate the impact of above. Now, what we see, we are doing for our own understanding. Okay, we have doing for our own understanding. Is it? You do it. Is that? It is very, very important. I'm only concerned about this. You have to write explanation for 31/12, 31/12/2005 and 31/12/2006. Writing is very important. Okay, it is a lifeline for that. Fine. Now, what you are writing, we are not writing anything. We are just writing what we have done. Okay, we are only writing what we have done. That's all. I will write for the first one. You have to write for the next two. Fine. You have to. I see here. I'm little bit more specific. Okay, little bit more specific. I will not say I'm strict, but I have to be very conscious about this. And you should also be that. See, at reporting, you write in your own words what you understand, how you are understanding. There is no compulsion that you have to. At reporting date, at the reporting date, the estimate employees leavers, is it right? Leaving is how much? Is 8 plus 18. Okay, it comes to 26. Is it? Based on the average increase in sales, is it? Average increase in sales volume. Okay, they are entitled how much? They are entitled to 200 share options. They are entitled to 200 share options. Okay. Now, the fair value of each option, the fair value of each option is $10. Is that the duration? Is that the duration? Is that the duration is how much? 1/3. Is that the component of equity? The component of equity is 116. Okay, whereas it has to be shown in where we have to show this component on the equity.
The financial position.
In the statement of financial position. Is it on the vesting date? Okay, on the vesting date. On the vesting date is on the vesting date. Okay, the expenses during the year ended. Is it right? During the year. You can write in your own words. Okay, next time I will write the same thing, I will change. Okay, it is very hard that we are, but only important thing is the expenses during the year ended 31/12/2004 is how much? 160. Is it? It is how much? 160. Now what will happen in the second case? In the second case, what will happen? Is that see, everything will be same. Okay, or everything will be same. See, 31/12/2005. Okay, 31/12 at reporting date. At reporting date, we have to take the grand date, all those grand date. We have to use that words also. What happens during the grand date? What is happening during the vesting date? Okay, what happens during the vesting date also. At reporting date 31/12/2005, the estimated levers. Is that estimated employee levers? Okay, employee levers are how much? It is 8 plus 6 plus 4. Okay, 8 plus 6 for 4, 18. Is that based on the average, increase in sales volume? Okay, on vesting date. Is it right? How much is the sales volume? It is 16%. Is it right? How much is this? 16%. They are entitled. Is that they are entitled? You can put employees are entitled to how much? To 300 share options. Is that the share options? The same thing will happen. Is that the fair value of each option is considered, is measured based on, is measured based on $10. Is it right? Is whether the duration is how much? 2/3. Is it? The component of equity. The component of equity is how much? The component of equity is 364. Is it 364? Whereas the net expenses, okay, net expenses during the year ended 31/12/2005 is how much? 364 minus 116. It comes to 248,000. Is it right? It comes, this is thousands, okay? This is in thousands. Are you clear about this?
Yeah.
Is it fine?
Yes.
This is this simple way. Okay, now you can say, now you can understand. See, you should know the techniques. That's all I will tell you all the time. We have to work smart. How we have to take the thing. The more you practice, it will be easy. Can you do it for the next one, 31/12/2006?
Yes, sir.
Okay. Is it okay, Juhana?
Yeah.
Okay, do it, try it. See, I am giving you two options. You try it. Nothing will happen. Don't say that it will be right or it will be wrong. Always, till the last moment, there will be improvements. Till the moment you start it, you will make changes. Always, I will give suggestions how best we can improve it. Is that till the last moment, there will be suggestions. Fine. Now, what is that accounting after the vesting date? Means you are accounting after the vesting, how it has to be shown. IFRS 2 state that no further adjustments to total equity should be made after the vesting. After vesting date, you should not make any changes. Okay, this applies even if some of the equity instruments do not vest. It applies to all. Okay, you should not do any changes once the date has been expired. As simple as that. Entities may, however, transfer any balance to other component of equity from other component of equity to retain earning. If there is any balance is there, it belongs to the entity, but it doesn't belongs to the ultimately it belongs to the shareholders only, retain earnings. Okay, retain earnings belongs to the shareholders only. But what we have to do after vesting date, we should not make any changes. Okay, we should not make any changes. Fine. Now, read this question. First, read the requirements. What they say, this much only the requirements. Okay, what they are saying. Is it? Show how the option schemes will affect the financial statements for each of the 3 years of the vesting period. Show the accounting treatment at the vesting date at each of the following situations. The fair value of the share is 5 and all eligible directors exercise their share. Share options means you have the option to buy it. Okay, you have the option to buy it, or you have the option to not to go for the option, or you can take the option, or you cannot take the option. The fair value of the share is 1.5 and all eligible directors allowed the share options to lapse. Is that, see the thing? What is it? Now, they have allocated the shares. Okay, they have allocated the shares. Assume they have allocated the shares on the grant date. Now they have allocated at $3. Okay, if the value of the share will increase, okay, people will buy. Okay, the directors will, whoever it is there, they will buy. If the value of the share is decreasing, okay, assume 1.5. Take the same example. We will not be very attractive. We will not get very interesting in going for the option, because definitely you maybe lose. There are so many things maybe behind that. Then we will see whether we should go for it or we should not go for that option. They say that okay, if the value is increasing, they will opt the option immediately. If the value is decreasing, definitely they will think about postponing, or they will not take that option. Fine. Beginner offered directors an option scheme conditional on a 3-year period of service. Divide the sentence. The number of options granted to each of the 10 directors at the inception grant date of the scheme is how much? 1 million. The options are exercisable shortly after the end of 3rd year. They cannot option. They have to complete the vesting period. Vesting period is nothing but when it is the 3 years when it is going to be ended. Upon exercise of this option, those directors eligible will be required to pay 2 for each share of one nominal value. There is a condition. What they say, when you are exercising the option, you have to pay $2. Is it? When you pay $2, definitely you will get the value with respect to $5. Now you understand the mechanics of the things, okay? You can understand the thing. When you are paying $2, you will get a value of share of how much? $5. Yes, it is very attractive. $5 share you are getting at 2. When you are paying $2 and you are getting a share of 1.5, will you go for that option? Is it? Will you go for that option? Will not go for that option. Is it? Will not go for that option as such. Fine. What they are asking us? They are asking us how show how the option scheme will affect the financial statements. Okay. How many options are there? Year 1. Okay. At the end of year 1. The start of the year 8 million. End of year 1 is how much? 7 million. End of year 2 is how much? 8 million. And end of year 3 is how much? 9 million. Is it? End of year 3 is how much? Now, fair value of the options are how much? 0.3, 0.33 and 0.37. Okay. Rights expected to vest is how much they have given. There is no employees. There is nothing like employees. Is that we don't have any employees as that. Okay. We don't have any employees out there. We have to take the same thing. Okay. Year end. Are you clear about this?
Yeah.
Okay.
Yes.
Are you clear about this? Now you can do on your own. Is that you don't need my help? Is that year? What is the second column? Calculations of equity. Is that calculation of equity? Is it right? Equity and expense. Equity and expense. End of year 1. We are not a year ended. Here is it at year ended. How much year ended? Year 1. Okay. Year ended. They have not said which year. Is it at year ended? Year 1, year 2, year 3. Is it? They have not given anything. They have given rights expected. How much is there? 8 million. Is it at 8 million? What is the fair value? Fair value of the option is how much? Fair value of the option is 30. Okay. What is the duration we have to take? What is the duration we have to take? For 3 years. At the end of 1 year is how much? 1 by 3. Fine. What is the value you will get? 8 times 0.3 divided by 3. Is it right? Sorry. What we have done mistake? We have to take.
Didn't collect the shares.
We have to take 7 million. At the end of, okay, at the end of is how much? 7 million. At the end of second year, 8 million. At the end of third year, 9 million. Okay, how much you will get? 7 times 0.3 divided by 3. It comes to how much? It comes to how much? It comes to how much?
700,000.
0.7 in thousands. In thousands also, if you put in thousands also, you will get how much? This is what we have to be very careful. 700. Okay. Equity will be how much? 700. Year 2, how much is there? 8 million. What is the share option? 33. Fair value of option. 2 by 3. How much is there? 8 times 0.33 times 2 divided by 3. It comes to 1 minute. Again we have, again we see, again we have made, see, is it right? What mistake we have done?
Doctor, question, why we took 0.33 instead of 0.37?
Yeah, fine. Okay, we should not take 0.33. Why we should not take 0.33? Tell me, Svetlana.
So I'm not really sure.
Because when we are giving the share of shares, is it right? The fair value should be taken on the grant date. Is it right? The fair value has to be considered for the grant date. What is the fair value of the grant date? The fair value of the grant date is how much? 0.3. Have you done this in before? Just I mentioned you at the beginning of the session. Is it right? At the beginning of the session, I have mentioned here that the fair value should be at what rate? See the thing. The grant date is that where is that cash based payments? See the thing here. If it is the transaction with employees or other providing similar services, the fair value should be taken at what date? Grant date. Okay, the fair value has to be taken on a grant date. In other cases, we have, if it is with respect to services, cash based, then we have to take it on the date we have received. So that is the reason, is it right? That is the reason. Which value we have to take? We have to take the value as on grant date. Is it 0.30? Is it 08 million into 0? This is the grant date value, okay? This is the fair value times 1 minute. Is it right? I will write for your understanding, okay? Rights, okay? Rights times fair value at grant date. Is it fair value at grant date multiplied by duration? Okay, that is the reason we are taking the 0. How much you will get? 8 times 0.32 divided by 3. It comes to how much? It comes to 1,600. Okay, 1,600 minus 700. How much is the expense? 1,600 minus expense will be how much?
900.
900. Is it right? These are the estimates. 7 million this is the estimate, okay? These are estimate, okay? This is the estimate and this is also an estimate. And this is the actuals. This is the actuals. How much is the actuals? 9 million. Is it 9 million into 0.30 times 3 by 3? How much you will get? 2,700. Is it okay?
Yeah.
Is it 2,700 minus 1.6? Okay, it comes to how much? Expenses will be how much? 1,100. Is it right? Fine? Okay?
Yeah.
Fine?
Doctor, question.
Yeah, tell me.
If by mistake I forgot to multiply by 1,000, it will be wrong?
We have to be little bit careful. Okay? we have to be little bit careful. Okay, we have to be little bit careful. Okay, see, at this level we have to be very careful, not little bit. Okay, so we have to, that is the reason I will mention it, and I will put it the things. Okay, we will not come in the examination. Now you make very clear about your approach. If it is a small amount, take full value. If it is in thousands, in millions, then you put in thousands. Okay, you put it thousand. Okay, this is the checklist. Okay, this is the checklist what you have to follow at every time. Every individual will have its own style. Is that every individual will have their own style. Okay, this is the point number what? This is the point number A. Is it right? This is the point number A. What is the point number B? Point number B says that the fair value, what is the accounting treatment? When we say accounting treatment, what you have to write? We have to write the journal entry. Is that we have to write the journal entry. Okay, what they say that all directors will opt for this. Is it right? All directors will opt for it. Okay, will opt for this option. Now what will happen? See the things. How much they have to pay? They have to pay how much? They have to pay. They have to pay how much? They have to pay $2. Is it right? They have to pay how much? $2. What is the actual rights they are having? They are having 9 million. Okay, they have a 9 million. These are the rights. Okay, they have the 9 million. How much they have to pay? They have to pay 2 million. Okay, they have to pay. It comes to how much? It comes to 9 into 2. It comes to how much? It will come 18 million. Is it okay? Is it okay?
Yes, sir.
Fine. Is it okay? Now, this is what is happening. This is happening with respect to cash. Okay, this is happening with respect to cash. How many shares are there? What is the value of each share? They say the nominal value is how much? The nominal value is 1. Is it there? What is the nominal value? Nominal value is only 1. Okay, nominal value is only 1. Fine. How much is the nominal value? See, they are receiving this. Is it right? I will write it again, but I will write it again. It is the debit. Okay, what is the credit? Credit is the share capital. Okay, credit is the share capital. Share capital should be taken at a nominal value. Is that share capital will be taken at a nominal value? How much is the nominal value? 9 million into $1. How much it will come? It will come 9 millions. Is it right? It will come how much? 9 million. Now, how much they are exercising the options here? In the equity, is it right? In the equity, how much they are getting it at the end of the equity? They are getting how much? 2,700. Is it right? They are getting how much? 2,700. Is it right? 2,700. Now, fine, 2,700. What does it makes things, how you can interpret it? Can you tell me? I'm just telling you in the form of the T account. Okay, in the form of the T account. How much share capital is there? Share capital is 9 million. Okay, share capital is 9 million. Fine. How much cash they are getting? They are getting a cash of 18 million. Is that they are getting a cash of how much? 18 million. Fine. Is that they are getting a cash of how much? 18 million. They are getting a cash of 18 million and they are getting an option of how much? They are getting the equity options. Okay. How much is the equity option? They are getting an equity options of how much? 2.7 million. Is it 2.7 million? This is the equity options. Okay, is the equity options. Fine, equity, they are giving it, okay, in the form of equity. Okay, now how much is there? Which side is? Are you clear about this? This is only your understanding. Keep it in mind. Again, I am telling you this. They have a equity nominal value. Okay, nominal value is 9 million. 9 into 1. Okay, 9 into $1. How much they are receiving cash? They are receiving cash of 18 million. They are giving a fair value option. Okay, they are giving a fair value option. Rights to be vested. Is that ownership will be transferred? Ownership will be transferred means what will happen? The equity will increase. Okay, the equity will increase after the vesting date. After the vesting date, the equity will increase by how much? 2.7. Okay. Now, what is the total of this? You should ask me. If you have any doubt here, you have to tell me what equity options, how we are treating. Okay. It comes to how much? It comes to 20.7 million. You have the difference on the right hand side. What is this difference?
Share premium.
Share premium. How much share premium? 20.7 minus 9. 20.7 minus 9. It comes to how much? 11.7 million. It is little bit thinking point. Okay, little bit thinking point. Isn't it? How much we have vested the shares means we have, when we have been vested the shares, 2.7. Okay, 2.7. It is in millions. Is it right? It is in millions. Are you clear about this?
Yeah.
Fine. Now we have to write the debit. Is it right? We have to write the thing. From where we will issue this? That is the issue. Is it right? Where we are first time you are doing this. You have not done this before at any time. Okay? You have not done. From where we are going to issue, there will be some specific reserve whenever you are talking about the things. Is that whenever you are talking about this type of share based options, we will have the reserves. That reserve is called as a equity reserve. Is it right? That equity option, it is called as a equity reserve. How much equity reserve? 2.7 million. Okay, 2.7 cash is 18 million. Equity reserve is 2.7, share capital is 9 million, and share premium is how much? Share premium is I will put 20.7 minus 9 million. Difference is how much? 11.7 million. Is it right? 11.7. Little bit. See, I will put it this. Okay. I will put it a red mark here. Little bit. You have to be. We have to focus at the time of revision. Okay. Are you clear about this? Okay, next. If they don't vest, what is the point number B? They say if they don't vest, if they allow it to lapse. The rule says that if they allow it to lapse, the transfer any balance from other components of equity to retain earnings. Entities may, however, this is the point, okay? Entities, however, transfer any balance from other component of equity to the retained earnings. Nobody is going to opt for that. Definitely, we have to pay $2 and we have to get the value of share of 1.5. Who will go for this? Nobody will go for this, is it? Nobody. We have to think in that way. Is that we have to think what is the price we have to pay. If you are paying $2 and you are getting a value of $5, we will be more motivated to buy. But if you have paid $2 and we have to get a value of 1.5, definitely it is not going to be attractive. Okay, what we have to write? No options has been exercised. Okay, simply we don't have anything. Is that simply you have to transfer it to whom? They have to transfer it to the retained earnings. Is that how much we are going to recognize? Is that we are not using the reserve? Is that we are not using this amount? Okay, we are not using this amount. Is that the amount recognized in equity is how much? The amount recognized in equity is how much? In equity will be how much? 2.7 million. Okay, 2.7 million. And this and this amount, is it right? And this amount will be transferred to retained earnings. Are you clear about this?
Yeah.
Fine. Is it okay? Little bit, okay? Little bit. We have to focus how it is going to be worked out. Is it okay, Svetlana?
Yes, sir.
Okay, next. Modification. Any changes we have doing. Modification to the terms on which equity instruments are granted. If there are any modifications, we have to do accordingly. As simple, the basic fundamentals will remain same. Any entity may alter the terms and conditions during the period. It may increase or it may reduce the exercise price of the options. Is it right? This makes the scheme less favorable or more favorable. If you are introducing the exercise price of the option, people will buy, people will not buy. Okay, based on there is no condition. It might change the vesting option to make it more likely or less likely the options will be vested. Is that any conditions has been changed? Definitely people will very smart. They will say that if it is attractive, they will buy. If it is not attractive, definitely you will not buy. Okay, if the modification of equity share-based payment schemes occur, must continue to recognize the grant date fair value. We cannot change the grant date fair value of equity instrument unless instruments do not vest, because to meet non-market based vesting conditions. They are mentioned here. They have mentioned in one of the cases what they have mentioned. See, market based conditions and non-market based conditions. Market based conditions is nothing but they are factored with the fair value. Therefore, an expensive non-market based condition must be taken into account whether the expense should be recognized in the reporting period. They say whether the expense should be recognized in that is the non-market based condition. Is that from next class, revise it, okay, please. Now you have to, they say pull up the socks, okay, you have to start revision. The moment I will say, see, this is the way I will make you more active. The moment I am asking anything, you should be in a position, it will take time, but you should be in a position that somewhere in this page number we have done this. Is that somewhere in this page number we have done this? That much, somewhere in this chapter we have done this. This much has to be there. Almost we are 50% through the syllabus. Now it is time to start revision. It has to time to make things very, very focused. Fine. What they say, if the modification increase the fair value instrument, then the extra expenses must be recognized. Is that? If the fair value is increasing, you have to have the difference in the fair value of new arrangement and fair value of original arrangement at the date of modification must be recognized as a charge to profit and loss account. If there is any difference in fair value, we have to charge means deduction. Charge means expense. The extra expenses is spread over the period from the date of change to the vesting. Any means you have to spread it, okay? You have to, we should not focus it, we have to spread it. Now they gave you a small example on this, okay? Very interesting. What they say, they are asking you to calculate. Is that very, very simple? I am very much particular about this. The amount to be recognized in financial statement each of the 3 years of the scheme. What it says, read the question once. They grant 100 share option to 500 employees. Okay, they are granted 100 share options to 500 employees. Same process. Process will not change. Keep it in mind. Till the last question, the only we will add one step, but we will not deviate from the original one. They have 100 share options, 500 employees. Provide they remain in the service for the next 3 years. The fair value of each option is 20. Is it right? During the year 1, first year, how many employees will leave? 50. The entity estimate further 60 will leave during the year 2 and 3. At the end of year 1, the entity repriced the share option. They are changing the option value. Okay. The other vesting conditions remain unchanged. At the date of repricing, the fair value of each of the original share granted before taking the repricing was 10. The fair value of repriced is how much? 15. Before it was 10, now it is 15. How much is the difference? 5. During the year 2, 30 employees left. The estimate for the 30 will leave during the year 3. During year 3, what are the actual employees? During the year 3, actual are 30 employees. Okay. During the year, actual is 30 employees. Now what is happening? What we have to do? Tell me. Here calculation of equity, equity component and expense component. You can, if you want, we can write the things also, okay? But understand, okay? Whatever we are understanding, write down the thing. I will ask you to write whether it is needed or not needed. The only thing is it makes us to have a good practice for that. Okay, it makes to have a good, whatever we are doing, we have to write. Okay, now how much is the first year? How many first year? Is it at year 1? Is it at year 1? Year 1. Tell me how many employees are there? 500. How many they are leaving in first year? How many employees are leaving?
50.
50. They are expected to leave how much? They are expected
60.
to leave how much? 60. Are you clear about this? How many options are there? 100 options. Okay. What is the fair value of each option? At the grant date, fair value of each option is 20. Time. What is the duration? 1/3. Are you clear about this? Yes, Johanna.
Doctor,
Huh.
here mentioned 50 employees to leave and the estimate 60.
Will leave.
Why we are taking both?
See what they say during year 1, how many will leave? 50 employees. The entity estimate that a further 50, another 60 employees. Is it right?
Okay.
These people will leave, 50 will leave. Okay, this is only estimates. Okay, this is first year, second year, third year, fourth year, fifth year, whatever is there. Last year actuals, other years are estimates only.
Okay.
Okay, other years are estimates. This is what we say. We are talking about what? We are talking about, I will put the things. Is it? I will put one line for this. This is for this and this is for this. Are you clear about this?
Yeah.
Okay, how much you will get? How much you will get? 500 minus 50 minus 60, 390. Is it right? 390 times 100 times 20 divided by 3. It comes to how much? 260,000. Check.
Yes.
Okay. Next year. See, simple. Nothing is there. Year 2. How much is there? Now you tell me. 500 minus 500 minus this 50 will come. Okay, this 50 will come. Okay, this 50 will come. Next, what will come else? What it will come? They have said a further 30 and a further 30. 30 minus 30. Okay, 30 minus 30. I am putting the things very, very specific here. You should not have any confusion here. This is 30 and this is, we have this option. That is the reason we can do it. Otherwise we cannot do it. Okay. This is 30 and this is 30 times 100 times how much? Times how much? 20 times 2/3. Are you clear about this? Are you clear
Yes.
about this? How much you will get?
Yeah.
How much you will get? How much you will get? 500 minus 50 minus 30 minus 30 equal to times 100 times 20 times 2 divided by 3. 520,000. Okay, 520,000. Okay, 520 minus 260. How much is the expense during the year? Expense during the year is how much? 260. Are you clear about this?
260. Yes.
Now again, what they have done is here very critical. Year 2. Is it right? Year 2. they said that the fair value is going to be how much in year 2? The year 2, the fair value, at the date of repricing, the fair value of each of the original option granted was 10. The fair value has been repriced to how much? 15. Is it? The fair value has repriced to how much? 15. See, this is the why we are taking 20 means this is the rule says that if we are talking in terms of shares, the fair value which you have to calculate is the value which is going to exist on the grant date. Okay, grant date, that is the condition. That is what we have done. They will give some more fair values, but we should not consider those fair values. Now, what they have done, they said that the fair value has been changed to how much? 15. Okay, fair value has changed to how much? 15. Fine. Now, when it has fair value has changed to 15, what is the difference in the fair value of each price? See the thing. The fair value of each original shares option granted before taking the repricing was on how much? 10. The fair value of each repriced option is how much? 15. How much is the difference here? Difference is how much? Difference is how much? Difference is 5. Okay, difference is 5. This is value. We are not comparing what is the happened in the grant date. Okay, what happened during the grant date? No, during the at the date when they are repricing. At the date of repricing, is it at the date of repricing? Before it is 10, after it is 15. How much it has been increased? 5. This is the additional expense. Is it? This is the additional expense. Now, for this happens in year 2. Okay, this happens in year 2. 500 minus 50 minus 30 minus 30. It will remain all same. 100 will also remain same. But what we are doing here, we are taking how much? We are taking $5 difference. Is that we are taking what? We are taking $5 difference times. What is the duration? Is it 2 by 3? How many years are left?
1 by 2.
1 by 2. Okay. How many years are left? 1 by 2. Year 2 is year 2 and year 3. That's all. Is that year 2 and year 3? How much we will get? 500 minus 50 minus 30 minus 30 times 100 times 5 divided by 2. It comes to how much? 975. 97,500, sorry. It comes to how much? It comes to 97,500. Are you clear about this?
Sorry, doctor, but I got confused. Why 1 divided by 2?
Yes, 1 divided. This only this adjustment. Only this adjustment. Only this one has been done. How many years are there? Year 3 is there. That's all. Okay? Year 3 is there. Is it? Because only 2 years are there. Year 2 and year 3. Because year 2 and year, how many? See, 1 by 2 is what? This is the remaining years.
Yeah.
Is it? This is the remaining year. This is the year which has been lapsed. Is it? 1 by 2. Because, okay? Is it? Year has been lapsed. See, what we are doing, one duration is what? 1 by 3. Means for this is the 1 year has been lapsed. Number of years are how? Total number of years are how much? 3 years. Here 2 years has been lapsed. Total number of 3 years are how much? 3. Okay, usually we used to do like this. Is it right? You take all the examples. What we have done? We have done in this way: 2 by 1 by 3. Is it 2 by 3? 3
Yeah.
by 3. Are you clear?
Yes.
Now what happened? They have made changes in year 2. Is it right? See, this is one block. Okay, this is one block. As simple as that. Is that this is a complete one? This is happened for which year? This is happens for year 2. Is it? This is happens for which year? This happens for year 2 only. Year 2 only. One is normal, one is the difference. Is that one is the
Okay.
difference? Okay, one is the difference. You can put it in technical terms. You can put it like this. You can put it as incremental. Okay, you can put it as means addition. Okay, incremental means the addition. Are you clear about this?
Yes.
How
And
much
why
is the,
we didn't divide the equity and the expenses?
here 97,500?
Yeah.
See, this is only for next year we will do. Is it? Next,
Okay.
okay, next year we will do. Okay, year 3 we will do.
Okay.
Fine. Year 3. How much is there? 500. Okay, 500. How many employees are there? A further 30 employees will leave. Okay, a further 30 employees. First, how many employees they have left? 50. Second year, how much they have left? 30. Third year, how many will leave? 30. First, we will do the normal, then we will do the incremental. Are you clear now?
Yeah.
Okay, now it will be now. Okay, that is why the more you ask me now, the more I will be in a position to give. I will get idea to give you more options. Okay, 100 times how much is there? $20. How much is there? 3 by 3. Are you clear about this?
Yeah.
Is it right? How much you will get? 500 minus 50 minus 30 minus 30 times 100 times 100 times 20. It comes to how much?
780.
780.
780.
Okay. Now how much we will take here? We will take here how much? 780 minus 520. Okay, 780 minus 520. This 520 comes from where? This 520 comes from here. Okay, how much is the expense? 780 minus 520. It comes to how much? It comes to 260.
60.
Are you okay?
Yeah.
Next, incremental. What we are doing incremental? 500 minus 50 minus 30 minus 30 times 100 times 5. Okay, times 100 times 5. Here what we'll do? 2 by 2. Are you clear about this now?
Yeah.
Okay, now how much you will get? 500 minus 110, 390. Okay, 390, 100 times 5.
195.
195. Now 195 minus which one we will deduct?
975.
975. How much you will get? $97,500. Are you clear about this?
Yes, sir.
Okay. We forget to do total here. Okay. This is the total for first year. Okay. And this is how much is the total for second year? Just tell me. Total. Year 2, okay? Only year 2. Year 2 total. Is it right? Year 3 total. 520 plus 97,500. It comes to how much? 617,500. 260 plus 97,500. It comes to, check again, 357. Sorry. Is it 357? 357,500. Here how much you will get? 780 plus 195. 780 plus 195. 975. 260 plus 97.5. It comes to 357. 357,500. Are you clear about this?
Yes.
Okay.
Yes.
Is it? Even it is not required. Okay. Even it is not required. Write explanation. Same thing you have to write. Okay. See, I am telling very slowly. Understand that, then you have to work it on the thing. Is it right? The entity must account for the entity should account the share options based on the fair value at grant date. Okay, it is all in recording. Is that it is all in recording. Now what happened? They have done the repricing. Okay, they have done the repricing. Repricing is nothing but they have to make the calculations for the readjustment with fair value. Okay, repricing means they have to make the adjustments for the repricing. What we have to do, increase whatever the difference is, right? Whatever the incremental expenses, is it right, to be charged to profit and loss account. Incremental expenses to be charged to profit and loss account, you have to spread it over a period of remaining years. That is the reason we are doing 1 by 2 and 2 by 2. Okay, spread over the reasons. Now year 1 we don't have any issue, is that the year 2 they have the repricing. What is the incremental amount? Incremental amount before repricing and after repricing is, write down within brackets $15 minus $10 equal to $5. Wherever is mentioned, be very simple. Make it a point. Make it simple. Make it very easy. Is it? Now, for second year, how much is the incremental amount? Incremental amount is 97,500. Okay, is apportioned to the equity, and 97,500 is charged to profit and loss. Year 3, on the vesting date, based on the vesting date, okay, vesting period. Vesting period means at the time it has going to be transferred. You have to use vesting period, okay. What is the additional cost we are going to have? Additional cost is going to be, now again you have to mention how much is there. It is at the rate of $5, 2 by 2. Is it right? The spread over the years, 2 by 2. 2 by 2, if you write 2 by 2, it is understandable. How much is there? The equity will be, incremental equity will be 195, and the expenses charged for year 3 is how much? 97,500. Within brackets you have to write 195 minus 97,500. Are you clear about this?
Yes.
Is it okay? Write down. Okay, write down the things. The moment you, is it okay, Johanna?
Yeah.
Okay, write down and send me. What you have done previously, it is the best practice. Okay, Even I am writing, you understand, I gave you the answers to you. You read the answers. Very importantly, you read the answers, understand how they have written, how the language is there, how the presentation is there. Try your best to write down like that. You keep it open. I'm telling you this. Very simple. You keep it open. But first read it, read it, understand it, then without seeing, you write on your own. Keep it open on the left hand side, nothing will happen. But first read it, understand it, that this is the way there. Don't force yourself to write as it is. Very simple. I'm telling you this. Don't force yourself. And it is not like we have to memorize it. No. The style, the way presentation, try to write in that way. That's all. If you force yourself, you will be really get in a panic situation. Are you clear about this?
Yeah.
Fine. What is the next one? They are talking about cancellation and settlements. Okay. Any entity may cancel or settle share option scheme before the vesting date. Before the vesting date, they have the option. If the cancellation settlement occurs during the vesting period, they immediately recognize the amount that would otherwise be recognized for services received over the vesting period. That an acceleration means if there is any cancellation, they will immediately recognize the amount. It is right, that is otherwise going to be recognized. Any payment made to employees up to the fair value of equity granted at cancellation or settlement is accounted as a deduction from equity. If you have made any payment to the employees, that amount will be deducted from the equity. Any payment in excess of the fair value of equity settlement is anything excess. Anything excess should be treated in the profit and loss account as an expense. Two conditions are there. It has to be immediately recognized. If already paid, it has to be deducted from the equity. If it is anything we have paid in excess, it has to be deducted, it has to be charged to profit and loss account. Okay? Next. This is the last question for equity based settlements. Okay? This is the last question. Now, what they have mentioned, first read the requirement. Explain, now they are asking, explain with calculation. How the only calculations you have to explain. Understand my point? How we did first do the calculations, next you make an explanation. That's all. How the cancellation and settlement should be accounted for the year ended 31st December 2001. An entity introduced an equity settled share based transaction scheme January for 5 directors. Under the terms of the scheme, they will grant how much? 100 options. If they remain in employment for next 3 years, all 5 of the expected to stay for full 3 years. The fair value of the option date, now you will have more clarity, more understanding. The fair value is how much? Fair value is 8. We have to take the fair value. Okay, fine. Now, on 30th June, see on 30th June, after 1.5 years, the entity decided to base its share-based payment schemes on profit targets. Instead, therefore, they cancelled the existing scheme. On 30th June, they paid compensation of 10 per option to each of the 5 directors. The fair value of this option is how much? 9. Okay. when they have, when they have given the options, January 1st, 2001, and when they are reporting 31st December 2001. 1st January 2000 and 30th June 2001 they have cancelled it, and we have to account it for how much? We have to account with 31st December 2000. How we have to do? Tell me first. What you have to do? Any idea? What is the value of, what is the grant value? Grant value is how much? Grant, the fair value on grant date is how much? 8. Okay, the fair value on grant date is how much? 8. How much is the options? How much is the options? 1000 options. How many directors are there? 5 directors are there. Okay, 5 directors are there. Fine. Is it right? See, is it right? Cancellation and settlements. Is it right? What are the, first you should take, see what they have done. They have cancelled. See, there are so many things are there. First, they have cancelled it. Is it right? See, if you follow these 3 steps, if the cancellation occurs during the vesting period, the entity immediately recognize the amount that would otherwise be recognized for services. First, you have to first do the thing. This is the first step. This is the second step. Or any payment made to employees up to the fair value of the equity granted at cancellation or settlement is accounted. Any payment made to employees in excess of the fair value. Is it right? In excess of the fair value. Is it right? In excess of the fair value. How much they have made compensation? They have made compensation of 10. Fair value is how much? 8. 8 means they have paid how much more compensation? They have made compensation more of how much? 2. Okay, they have made a compensation of how much? They have made a compensation of how much? What is the fair value? The fair value of the options on June 30th, 2009 is how much? $9. On June 30th, 2001, it paid compensation of 10 per option to each of the 5 directors. Okay, the fair value of the option, they said very clearly, in excess of the fair value. Is it right? In excess of the fair value. In excess of the fair value means we have to take fair value. How much they have paid? In excess of the fair value. The value is how much? In excess of the fair value. How much is the fair value? On 30th June 2001, 9. Okay. On 30th June 2001 is 9. That is the fair value. Is it right? Now, how much they have paid compensation? The fair value is $9. They paid compensation is how much? They paid compensation is 10. How much they paid more? They have paid more of $1. It has to be charged to profit and loss account. I will write again very in a structured way. Is that it has to be charged to profit and loss account. How much they have paid compensation? 50. If they have paid compensation, what we have to mention? It has to be deduction from the equity. Means equity has to be decreased. If equity has to be decreased, equity has to be debit. Is it right? It is a liability. If liability is increases, it is credit. If the liability is decreasing, it is going to be debit. Fine. Two steps are there. Is that two steps are there? Okay? We will explain it. Okay? We will explain it. Okay? Fine. How much is the total expenses? Total expenses are how much? Total expenses are how many directors? 5 directors. Okay? 5 directors. How many options? 1000 options. Okay? 1000 options. How much is the fair value? Fair value at grant date. Okay? Fair value at grant date. How much? $8. It comes to how much? 5 times 1000 times 8. It comes to 40,000. Is it right?
Yes.
Is it right? Next, we have to take the expenses. Because they have cancelled. Is it right? Expenses to be recognized. Is it right? Expenses to be recognized at the end of year 1. Is it right? At the end of year 1. Is it right? What is the 5 directors? Okay, 5 directors times 100 options. Okay, times 100 options times what is the fair value? 8 times how many years? 1/3. Is it right? 1/3. How much you will get?
13,333.
13,300. Difference 7,666,26667. Is it right? Expenses to be recognized in future. Okay, are you clear about this?
Yes, sir.
Now, what is the journal entry we will write? What is the journal entry we will write? How much expenses to be recognized? Expenses to be recognized is how much? Expenses to be recognized is how much? 26,000. Means still there is this much component of equity is there. Okay, this much component of equity. Still here, see, we have to pay it back. Okay, we have to pay. How much we have paid? 13,333. Is it right? 13,333 in the year 1. And future, how much you have to pay? We have to pay how much? We have to pay 26 if it is going to be continued. Okay, condition is there. Is it? What is the debit and what is the credit? Is it? It is going to be equity. Is it right? It is going to be part of equity. Fine. Now it is the expenses to be charged, profit or loss. Is it right? Profit and loss 26667, and equity component will be how much? Equity component is 26667. Is it? See, when you are talking about expenses, see, make it clear. You should be very clear here. Is it? For the remaining period. Is it right? For the remaining period. For the remaining period. Is that this is for the current year. This is for the year 1. Okay, this is for the year end of year 1. Fine. Now, what we have to do? They have cancelled it on 30th June. Is it how much they have paid? They have paid 10. Compensation paid is 10. Fair value is how much? Fair value is 9. Is it how much they have paid extra? They have paid extra of $1. Is it right? It is a loss. Okay, it is a loss. How much they have paid? $1. Okay, how much they have paid compensation? They have paid compensation of 10. Okay, they have paid compensation of 10. Now, what the rule says that if any payment made to the employees up to the fair value of equity, then up to the fair value means equal to fair value, then it has to be deducted from the equity. Any payment made to employees in excess of the fair value of the equity, instruments guaranteed, anything paid excess of the fair value of equity, is it a fair value of equity? It has to be on the settlement date, it has to be expense. Here I will write here how much they have paid. They have paid how much? They have paid 10. Okay, they have paid how much? 10. Is it right? They have paid 10. Fine. How much they have paid extra? They have paid extra of $1. Okay. How much is the equity, fair value of equity? Fair value of equity is 9. Is it right? Fair value of equity is 9. What will happen? Here the equity will decrease by debit. Here profit and loss account. Is it right? It is debit. We are paying cash. It is going to be credit. Is it right? It is going to be credit. Is it? This is for the second part. Is it? This is for the second part. I am leaving some space for explanation. Okay? I am leaving some space for explanation. I will write explanation here. Is it? What is there? How much is the? Is it right? The compensation. The compensation paid to the directors. Is that to the directors at the rate of $10. Okay, at the rate of $10. Is it right? At the rate of $10. Fine. At the rate of $10. Fine. Now the excess is how much? The excess is $10 minus $9. Is it right? The excess is $1 to be charged to profit and loss account. Is that profit and loss account? The equity, the compensation, is that the compensation paid, is it right? The compensation paid should be deducted from equity. Is it right? Should be deducted from equity. Now, how much is there? How much is the amount they have paid? Compensation paid. Compensation paid. Is it right? How much is there? 5 directors. Is that 5 directors? 1,000 options, 10. Is it right? It comes to how much? 50,000. It comes to how much? 50,000. Is it right? Debit with what? Sorry, it is not debit. Sorry. Is it compensation? Fine. Okay, keep it like that. It will be what? It will be credit will be cash. Fine. How much they have paid extra? They have paid extra of 1. Okay. How much they have paid? They have paid extra of 1. Is it right? Now, What is the fair value? Fair value of option. Is it fair value of option? What is they have given? The any payment made to the employees up to the fair value. Okay, fair value of option up to the fair value. Up to the fair value. Up to the fair value is how much? 9. Is it up to the fair value is how much? 9. Is it? What is the how we have to calculate? 5 directors, 100 times 9. It comes to how much? 45,000. What happens? You have to reduce the equity. Is it? You have to reduce the equity. If you want to reduce the equity, it should be debit. Any excess, is it? Any excess of over fair value, okay, to be charged to whom? To be charged to profit and loss account. How much is there? How much is there? $10 minus $9. It comes to $1. Again same concept. 5 directors, 100 options times 1. It comes to how much? It comes to 5,000. It has to be charged to profit or loss. Debit. It has to charge to profit. What is the general entry? The same thing you will write, okay? General entry. Debit will be equity. Is it? Debit will be equity. How much? 45,000. Debit will be profit and loss. 5,000. How much? Credit will be cash. How much? 50,000. Is it clear to you?
Yeah.
Revise it. I am saying start from now. I am telling you, start from now. Revise it. Don't keep till the end. When you don't have class, on the day of class, any time, half an hour, what we have done, revise it. When there is no class, dedicate 1 hour, not more than that. I am telling you this. Don't keep anything November, you should not do anything new. If you follow this, minimum you will get more than 65. Inshallah. Minimum. I am telling you this. The moment you pile up and will say that I will start next month, I will start October, I will start November, done. That is the close matter. Start daily. I am not asking anything more. Day of class, half an hour. When you don't have class, 1 hour. If you can spend more than that, fine. It is for your benefit. You will only get marks. I am not going to get marks. Marks will be under your name only. Marks will be under your. You will only wake up at 3 o'clock. You see the results. You will be happy. Understand? Don't pile up. Slowly and steadily. The moment you will go forward, more concepts will be there, more things to be remembered, more new concepts will come, and you have to adjust on that. Today, Monday, Tuesday. On Wednesday, I am going to take any question, I will solve it. One question, how much it happens, I will solve it. Wednesday, I will dedicate only to solve examination question. Fine? Is it okay?
Yes.
Now, see the thing. Whatever maybe I will miss, maybe I will forget, but you should not forget. What you have to do? You have to write explanation. Explanation is not nothing is there. Very clearly I am saying. Explanation is what you are doing step by step. That's all. Total expenses at grant date. is this much. Expenses to be recognized at the end of year is this much. Expenses to be recognized for the remaining period. For the remaining period, how it has to be accounted? The general entry, charge to profit and loss account, and accounted to equity. That's all. Explanation is not something magical. Explanation is not something which is out of the box. Explanation is only what you are doing. You have to make the explanation in your own words. When you are making explanation, don't, I'm telling you, maybe I'm little bit hard on this. Don't just tell only skeleton things. Write 1 or 2 sentences. Write something related to that. Write something. You see, the more, as simple as that, I'm telling you very clear example. You are doing business, you will have a good menu. The more menu, the more choice. The less menu, if you are going to a restaurant and having a menu card, if he gives a very little menu, you have a little choice to order. If they have a menu card for 5 pages, 10 pages, I'm giving you this example. Attractive menu card. You are having clear classification. Pricing is there. Everything is there. You have more options. Automatically, you place more order, they will get more revenue. Explanation is also like this. You are doing the calculation. You have to write as much as possible. The more you write, the more clearly you present, the more marks, optimum marks. I'm not saying more marks, the best marks you will get. It is all in your hands. Now, initially my role is more, your role is less. Now my role will decrease, your involvement in the subject will increase. Are you clear about this? Okay, fine. I will just cover this. Wait, is it right? We'll stop here. Okay.